Thanks for staying with us. Stay watching Market Sense.
Okay, time then to get cracking with the management of Hinduja Global Services. Remember that they came out with their earnings, and while no real fireworks really, we did see operating performance remain very stable. We did see a good 18.5% jump up though coming through as far as their profitability is concerned, at least on a quarter-on-quarter basis. So let's break down those numbers further. We've got Partha De Sarkar, who's the CEO of the company, who joins in on the show from Bangalore. Mr. Sarkar, thanks so much for being with us. Afternoon to you. After the first quarter, which was a little soft, we have seen earnings pick up. What was the sequential growth that we've seen in terms of the dollar revenues, and what do you think would be the breakup between volume growth and the pricing growth?
The volume growth will be about 12%. So what you're seeing is camouflaged because of the 3.5% adverse foreign exchange impact, which shows a net growth of about 8.5% in rupee terms. So mostly this is driven by volumes. Pricing environment is stable, so I wouldn't attribute a large part of this growth to pricing. It's been steady and stable, and there's nothing new on pricing. But I think volume growth, even on a full year basis, a full half year basis, it's come to about 12%, which is pretty strong growth, given the fact that we've got almost all geographies now running full steam. UK and Europe was a little bit of a laggard last year, but it's picking up pretty strongly. US has always been strong. Canada still remains a little bit muted, but we do see signs of recovery for the Canadian volumes coming in the second half of the year.
Do you think sequentially, however, we could see a big drop in Q3, because Q3 is a slow quarter for IT companies? Thanksgiving, Christmas holidays, holiday season. Do you think that could have an impact on your sequential performance?
Well, the way this works is we have seasonality in our business. So second half of the year is actually better than the first half. So our strongest quarters historically have been quarter 3 and quarter 4. So we kind of buck the trend a little bit. With open enrollment, which is a big event in the US healthcare industry coming in, and also holiday shopping coming in. So while it might be affecting our IT brethren, with holiday shopping coming in, there's a lot of volume that comes in because of that. So quarter 3 and quarter 4 have traditionally been our strongest quarters.
And if you look at the margins, while they have remained stable optically, the big thing is that you've absorbed pay hikes, you've undertaken payroll additions, and despite that, you've managed to maintain these margins. So going ahead, do you think that we could see that number possibly move up to that 12.5% to 13% range, or probably even more?
See, I will hesitate to give you a firm number, but I can give you a qualitative comment saying that we do believe that the margins will improve. And that's driven by a couple of things, which is this quarter margins have been affected by startup costs of our Middle East operations and also the ramp cost. We are ramping up in a big way in Philippines and India to handle the second half of the year. So the costs are actually there, the revenues haven't come in. The revenues will kick in quarter 3 and quarter 4. And once those revenues come in, we believe that margins will improve. Whether it will be 12%, 12.5%, I can't get into those specifics because we don't give forward guidance. But we do believe that our margins traditionally have been better in the second half of the year than the first half.
Telecom still accounts for about 30% of your total revenue. And if I look at global companies which are focusing on the telecom vertical, names like Tech Mahindra, they are not doing extremely well. In fact, they are looking at migrating outside the telecom vertical. So would you be doing the same?
So I can't comment on Tech Mahindra. I would say only this, that telecom is a tricky vertical to manage, but we've been doing this for a very, very long time. And one of the things that we've done is we've exited out of telecom from India, apart from 1 or 2 large clients that we have. So people who are probably still servicing the telecom companies of India, they may be having some challenge in managing those clients. But internationally, telecom is a growing sector. And it's not just telecom, it's actually convergence play, and in a way it's lifestyle, right? So you've got television, you've got media, it's a technology, media, telecom, triple play, convergence coming in. That's a very exciting sector. So we continue to remain very bullish on that particular sector.
Right. And also, if you can give us a sense of what's the leverage on the books right now, and how are you rather looking to pare down that number?
See, you will have to look at the leverage in our books as a combination of net debt, which is negligible, because we have got cash in our books also. And the cash in our books is in a different geography and is debt in a different geography because of historical reasons. So our net debt is actually marginal. We've got working capital, which is normal for our size of business, and we've got long-term debt, which is essentially acquisition financing or sometimes capex financing. Those are again in normative terms, and we have a repayment schedule because some of them are term loans. We have stuck to our repayment schedule so far as those term loans are concerned. And working capital, we try to manage it. Whenever there's excess cash, we pay down our working capital. So it's normal. I frankly don't see too much of a concern in our leverage position. It's very, very small if you look at net debt for a company of our size.
So final question, what about the cash flows? The ultimate benchmark for an IT company is that they generate a lot of free cash flow and which then again gets piled up as cash on the books. Will your cash flows improve significantly in this year?
They will improve, and if you look at it, our growth from a $60 million company to a $420 million company has been a non-dilutive growth. We've grown by the cash flows that have been generated by operations and the initial cash flow that came in when we sold the stake that we had in our telecom venture. So it's been non-dilutive growth. Cash has spurred operating cash, and the treasury cash has been enough for us to be able to grow from a $60 million company to about a $400 million company today. Cash has not been an issue. There's enough cash in the business.
All right, Mr. Sarkar, we leave it there. Thank you so much, of course, for taking out the time and, of course, giving us more insight into what lies ahead for Hinduja Global Services. But we'll take a quick break on that note and come back with lots more.